What is driving the recent volatility in gold prices?
That's right. Experts like Danielle DiMartino Booth and Chris Vermeulen are here to break it all down for you.
In this video, we summarize their key insights so you can stay informed without wasting time.
So stay tuned. We'll explore how recent interest rate hikes and shifts in investor sentiment are reshaping the gold market.
And remember, this content is provided for educational purposes, not as investment advice. Welcome to our review of the latest trends in the gold market based on insights from the Rebel Capitalist discussion.
Experts have noted a significant downward trend in gold prices, raising concerns among investors.
Recent discussions indicate that gold prices are under bearish pressure, influenced by a variety of economic factors.
The volatility witnessed in the gold market has left many investors anxious about potential losses.
The analysis points out that rising interest rates are significantly impacting gold prices.
Investors are reassessing their strategies in light of economic shifts, moving away from gold.
Experts have observed a shift in market sentiment, making investors more cautious about holding gold.
Predictions indicate that we may continue to see volatility affecting gold prices in the near future.
What can we expect in terms of the future for gold prices?
Some analysts suggest the short-term outlook remains bearish, with potential recovery dependent on broader economic stability.
In conclusion, it is recommended that gold investors diversify their portfolios.
Additionally, keeping an eye on key economic indicators will be essential for navigating this challenging market.
Today, we are examining the insights shared by Danielle DiMartino Booth on gold's recent fluctuations.
According to Danielle, the recent changes in gold prices are critical signals for investors reflecting economic conditions.
Danielle DiMartino Booth indicates that recent changes in gold prices are indicative of broader market trends.
She believes monitoring these changes is crucial as they can predict shifts in investor sentiment.
Danielle explains that economic uncertainty increases volatility in safe assets like gold.
She points out how quickly investor sentiment can shift, impacting market prices.
According to Danielle, investors must consider the economic signals that could influence their strategies.
Understanding the factors behind gold's price movements is key for sound investment decisions.
Danielle anticipates that if economic conditions remain unstable, we could see continued volatility in gold prices.
Market responses to inflation and central bank strategies are likely to influence gold investing.
In her conclusion, Danielle stresses the need for investors to monitor economic trends impacting gold.
She advises focusing on diversification and managing risk during volatile market periods.
Today, we are diving into the current state of rising defaults and what this means for the economy.
Graham discusses the challenges this presents for consumers and the banking sector.
Graham highlights that increasing defaults can create broader economic challenges.
He warns that these trends can lead to both financial strain on consumers and potential risks for banks.
What does Graham attribute to the rising default rates?
He notes that the increase in interest rates significantly raises borrowing costs.
Additionally, he emphasizes that economic strain is impacting consumers' ability to repay loans.
How are banks expected to react to these rising defaults?
Graham suggests that banks may adopt stricter lending practices.
This change could also prompt regulatory bodies to reassess their protocols. What predictions does Graham have for the banking sector?
He suggests stricter lending practices could emerge if defaults continue.
He also indicates that the overall economic recovery may face challenges.
Graham advises individuals to stay updated on banking developments.
He urges the consideration of financial strategies to navigate potential risks.
Being prepared for changes in the market environment is essential. Today, we are analyzing market trends with insights from Chris Vermeulen, shared with David Lin.
Chris forecasts challenges for gold and warns investors of potential market pullbacks.
Chris Vermeulen warns that gold may decline significantly, reflecting concerns similar to those during the 2008 crisis.
David Lin highlights that these concerns contribute to a fearful market sentiment. Chris mentions that rising inflation and interest rates could negatively impact all asset classes.
These rate hikes may create significant pressure not just on gold, but on stocks as well. Chris indicates parallels between today's market conditions and those leading to the 2008 crisis.
Such historical comparisons suggest a need for cautious investment strategies. Chris notes that many investors are moving towards safer assets due to market fears, though gold might not offer the protection it once did.
David Lynn underscores the importance for investors to adapt their strategies to current market dynamics. What are Chris Vermeulen's predictions for gold and the markets?
Chris predicts a significant downturn for gold, speculating a drop of around 20 to 30% as the market navigates these challenges.
Chris stresses the importance of frequently reviewing investment strategies due to market unpredictability.
He suggests diversification, advising investors to consider alternatives beyond traditional equities for stability.
Today, we will explore the economic risks highlighted by Emily Brown in her recent analysis.
Emily raises concerns about current market valuations and the potential for a significant downturn.
Emily Brown emphasizes that many market indices appear overvalued.
David supports this view, indicating it aligns with historical patterns that often precede corrections.
What insights does Emily share about rising Treasury yields?
Emily argues that rising yields lead to increased borrowing costs, negatively affecting equity prices.
What does David Lynn say about present market trends?
David notes that key indices are signaling bearish patterns, warranting investor caution.
What are Emily Brown's predictions for investor behavior moving forward?
She foresees that if current market conditions persist, we could experience downturns approaching 25%.
Emily emphasizes the importance of monitoring interest rates closely.
She also advises diversifying investment portfolios to safeguard against market volatility.
Today, we are exploring insights from Lacy Hunt and Lynn Alden, as shared through Adam Taggart's platform.
Lacy emphasizes potential risks in the economy, while Lynn focuses on inflationary trends.
Lacy Hunt identifies significant risks emerging in the financial markets, pointing to volatility and slowdowns.
Lynn Alden provides analysis of inflation trends and the critical need for strategic investing.
What specific concerns does Lacy Hunt bring to light regarding the economy?
Lacy warns that indicators of an economic slowdown are becoming apparent, urging caution among investors.
How does Lynn Alden approach the topic of inflation?
Lynn states that inflation remains a critical challenge, reshaping consumer behaviors and spending.
What forecasts do Lacy Hunt and Lynn Alden share regarding the economy?
Lacy foresees potential market corrections if current risks are realized, while Lynn expects inflation to continue impacting markets.
What key takeaways do Lacy and Lynn suggest for investors?
The experts recommend that investors prepare thoroughly for potential market swings, while emphasizing the importance of diversified strategic asset allocation in response to inflation.
Wow, what a wealth of insights from our guests today.
For sure. Lacy Hunt and Lynn Alden really set the stage with their thoughts on economic risks and strategic investment.
And Emily Brown hit home with her caution about overvalued markets, didn't she?
Absolutely. And Chris Vermeulen brought a powerful reminder of past crises that can shake investor confidence.
Plus, Graham Stephan's exploration of rising defaults shows the immediate impacts on everyday consumers.
And we can't forget Danielle DiMartino Booth, who clearly articulated the importance of monitoring economic indicators amidst gold price volatility.
What struck me was the agreement across the board about the significance of staying informed and adaptive.
Yet, they diverged on timelines and factors, like how Vermeulen views the echoes of 2008 differently from Brown's insights.
It just goes to show how complex and dynamic these financial markets are.
If you found this discussion as enlightening as I did, give us a thumbs up and subscribe for more expert takes.
Your support helps us keep bringing you the latest insights. Don't miss out.
Join us next time as we navigate through global trade dynamics and their intricate impacts on the economy.
See you then.